further discussing the world of stock options trading. In further discussing the world of stock options trading, it's essential for any investor aiming to navigate this market successfully to understand the Greeks. Among these Greeks, Theta stands out as a crucial element because of its direct impact on the value of options over time. Known as the time decay factor, Theta represents the rate at which an option's value erodes as the expiration date approaches. This consistent and inevitable passage of time can significantly influence an investor's strategy, at times turning potential gains into losses or vice versa. Theta is often described as the silent player in the options market, steadily and relentlessly working in the background. Each day that passes brings an option closer to its expiration date, and with each tick of the clock, Theta chips away at the option's extrinsic value. This decay is not linear. It accelerates as the expiration date nears, making Theta a critical factor for short-term option traders. For option sellers, otherwise known as options writers, Theta can be an ally. As time passes, the options they have sold decrease in value, assuming other factors like the stock price and volatility remain constant. This decay works in their favor as it increases the likelihood of the options expiring worthless, allowing them to keep the entire premium received when they sold the options. Conversely, for option buyers, Theta is a persistent adversary. The erosion of the option's time value means they are fighting a ticking clock, especially in strategies that require significant price movement in the underlying stock. For these traders, not only does the stock need to move in the desired direction, but it also needs to do so quickly enough to outpace the loss of value due to time decay. Understanding Theta's impact is vital for strategic planning in options trading. Traders employing strategies like long calls or puts need to be acutely aware of the time decay factor. They may need to adjust their approach, perhaps by choosing options with more extended expiration dates to mitigate Theta's impact, albeit at a higher upfront cost due to a higher extrinsic value. On the other hand, strategies like writing covered calls or selling puts can benefit from Theta. Here, the goal is often to earn income through the premium, with a favorable position on Theta decay. The trader's aim is for the option to expire worthless, allowing them to retain the full premium while minimizing the risk of the option being exercised. For traders, the key to harnessing Theta lies in a deep understanding of their own trading timelines and risk tolerance. Short-term traders need to account for Theta's rapid acceleration as expiration nears, while long-term traders might focus more on intrinsic value and less on time decay. In summary, Theta's role in options trading is a powerful reminder of the impact of time in financial markets. By factoring in Theta alongside other Greeks like delta, gamma, and vega, traders can develop more nuanced and informed strategies that align with their market outlook and investment goals. Whether it's exploiting Theta decay in selling strategies or mitigating its effects in buying strategies, a solid grasp of this Greek is essential for anyone looking to master the art of options trading. Strategic differences between speculating with trading futures versus stock options. Based on the investment vehicle, there are different risks and rewards. Futures trading is often considered riskier due to the obligatory nature of contracts and the leverage involved. However, this also means higher potential returns. Stock options, meanwhile, typically involve less risk, especially for buyers, and provide more strategic versatility, but usually require more sophisticated market knowledge. The risk and reward dynamics of futures trading versus stock options trading. In discussing futures trading, it's important to note that futures contracts often involve significant leverage, creating a high-risk, high-reward scenario. Futures traders are obligated to fulfill the contract regardless of market conditions, leading to potential substantial losses or significant gains. The leverage in futures trading magnifies results, serving as a double-edged sword. This heightened risk profile requires a solid understanding of the market and a robust risk management strategy. On the other hand, stock options trading typically involves lower risk levels, especially for option buyers. The maximum risk is generally limited to the premium paid for the option, making it more accessible for risk-averse traders or those new to the markets. However, it requires a more sophisticated understanding of various factors, including how different option strategies capitalize on diverse market scenarios. Options trading offers strategic versatility, allowing traders to profit from market movements, lack of movement, or even from volatility levels. Comparatively, futures trading provides a straightforward buy and sell approach with the potential for high returns, but its significant leverage can amplify losses, necessitating careful risk consideration. Stock options, while often presenting lower leverage risk and limited maximum loss, require complexity in strategy and understanding, which can be challenging for new investors. Market direction and leverage affects both stock options and futures trading differently. Futures traders need to accurately predict the market direction and often utilize higher leverage, amplifying both gains and losses. In contrast, options trading allows for strategies that can profit from market direction, uncertainty, or stability, with different leverage effects. A comparative analysis on how market direction and leverage affects futures trader and options traders. Futures traders must have a keen sense of market direction. Their success often hinges on the ability to predict market movements accurately and to leverage their positions appropriately. The use of leverage in futures can exponentially increase both profits and losses. Therefore, understanding the underlying assets, market conditions, and trends becomes crucial. This high-stakes environment makes futures trading more suitable for experienced traders who can navigate rapid market changes and understand the implications of leverage. Options trading provides more diverse strategies in terms of market direction. Traders can employ various strategies that benefit from different market conditions, including stable, bullish, bearish, or highly volatile markets. The leverage effect in options is different from futures. For instance, buying options can offer high leverage with limited downside risks, limited to the premium paid, while writing options can involve significant risk, especially if done naked, meaning without owning the underlying asset. How does liquidity and expiration affect stock options versus futures trading? Futures contracts generally offer high liquidity and have a set expiration date, leading to a more short-term, focused trading approach. Options also have expiration dates, but the variety of strike prices and types, such as the relatively common American or the ever-present but uncommon European options, offer more flexibility to the trader. Liquidity and expiration's effects on stock options trading versus futures trading. Investing using futures trading strategies involves understanding the dynamics of futures contracts, which are known for their high liquidity. This is particularly true in popular markets like oil, gold, or indices. The high liquidity of these markets facilitates easier entry and exit from trading positions. Additionally, futures contracts come with set expiration dates, necessitating traders to adopt a more short-term and focused trading approach. As expiration dates approach, traders need to be acutely aware of these timelines. They also need to consider the potential for rolling over contracts if they wish to maintain their position beyond the expiration date. In contrast, strategies employed by stock options speculators involve dealing with expiration dates as well, but here, the diversity of strike prices and the choice between American and European styles afford more strategic flexibility. Options traders can choose from a broad spectrum of expiration dates, ranging from a few days to several months or even years. This range allows them to align their trading strategies with various trading goals and timeframes. The flexibility in options trading enables traders to tailor their strategies to specific market views and desired timeframes. However, with the varying expiration dates, options traders must also be particularly mindful of time decay, also known as theta, especially as the option approaches its expiration date. This aspect of options trading requires careful planning and strategy adjustment to mitigate the effects of time decay on the value of the options. Strategic considerations in choosing your trading path. Both futures and stock options trading come with their unique set of strategic considerations. Futures trading offers a straightforward, high-leverage approach for those who can accurately predict market direction. In contrast, stock options trading provides a range of strategies that cater to various market conditions and risk appetites. The choice between the two should be based on individual trading goals, market knowledge, risk tolerance, and the preferred level of strategic complexity. As with any trading decision, thorough research, continuous learning, and sound risk management are key to success in navigating the intricacies of futures and stock options trading. Let's examine the investment goals and trading style investing using futures trading and stock options trading using a few different metrics. Let's talk about speculating or investing based on trading futures versus speculating or investing with stock options. Let's examine how they compare based on income generation versus speculation. Options trading provides diverse strategies like covered calls for income generation or protective puts for hedging. Futures are more suited for speculation and hedging against price movements in commodities or currencies. Investment goals and trading style in stock options trading. Let's talk about income generation and hedging using options. Stock options trading offers a variety of strategies that cater to different investment goals, particularly income generation and hedging. Strategies like writing covered calls allow investors to generate regular income from their stock holdings, turning them into productive assets even in stagnant market conditions. Similarly, protective puts can be used effectively for hedging, providing insurance against potential losses in stock holdings. These strategies make options trading appealing for investors who prefer steady income or wish to protect their portfolios against downside risks. Let's also examine long-term strategic plays using stock options. Options trading is also well suited for investors with a long-term orientation. By using strategies based on market forecasts or company performance, such as buying long-term call options, often called leaps, less commonly known as long-term equity anticipation securities, on stocks expected to appreciate, investors can leverage their market predictions with a lower upfront capital commitment compared to buying the stock outright. This aspect of options trading aligns with the goals of investors who base their decisions on fundamental analysis and long-term market trends. Trading futures versus stock options. Let's examine how they compare based on long-term versus short-term orientation. Options can be used for longer-term strategic plays based on market forecasts or company performance, whereas futures trading is typically more short-term due to the nature of the contracts. Investment goals and trading style in futures trading. Futures trading is well suited for speculation in commodities and currencies due to its inherent leverage and contract structure. Traders can take substantial positions with a relatively small capital outlay, which can lead to significant gains if the market moves favorably. However, this also brings increased risk, making futures more suitable for those comfortable with high-risk scenarios. Futures are also key in hedging against price movements in various assets. For example, businesses reliant on certain commodities can use futures to lock in prices, reducing the risk of price fluctuations. Futures contracts typically have a short-term nature because of their set expiration dates. This attribute makes futures trading appealing to traders with a short-term market focus, such as day traders or swing traders. These traders often use technical analysis or other speculative strategies to capitalize on market trends and fluctuations over short periods. The liquidity and high leverage in futures markets enable these traders to leverage even small market movements, potentially leading to significant profits or losses. In conclusion, stock options and futures trading cater to different investment goals and trading styles. Options trading, with its strategies for income generation, hedging, and long-term market plays, is well suited for investors seeking flexibility and risk management tools. Futures trading, on the other hand, appeals to those with a short-term market focus and a higher risk tolerance, offering opportunities for speculation and hedging in a variety of assets. Understanding these differences is crucial for investors and traders in aligning their trading strategies with their individual investment objectives and risk preferences.